I'm Thomas Neuhoff, and I'm representing Henry & Peters here, just wanting to update you on some of the recent questions that we've been receiving commonly from clients and others around the community. COVID-19 has caused economic disaster across the country, and many individuals are feeling this directly in their pocket. And so a lot of the questions we've been receiving have been around retirement accounts, primarily because many individuals have most of their liquidity and wealth in retirement accounts. And so the CARES Act, which was enacted on March 27th and signed by President Trump, relaxed some distribution rules around retirement accounts, and we just wanted to walk through some of those today. And so the first issue that we want to chat about is what's called a coronavirus-related distribution. And this is a new term, and it's a penalty relief provision for individuals who are under the age of 59 and a half and otherwise would normally be subject to a penalty for taking an early distribution from their account. And so for those who take an early distribution, there's normally a 10% penalty, plus that amount is subject to income tax. There are currently in the law a few exceptions to this, such as first-time home buyers or qualified higher education. And all the CARES Act did here is just add an additional provision for 2020 distributions if you qualify for a coronavirus-related distribution. And in order to qualify, you have to have either been diagnosed, or your spouse is diagnosed, or you have a dependent who's diagnosed, or you experience some sort of financial hardship due to COVID-19. And so these distributions can be made up to $100,000 during the calendar year of 2020, and the taxable income related to the distribution can be spread equally over the next 3 years. So it lessens the tax burden on the distribution. In addition to lessening the tax burden, the 10% penalty is waived for all coronavirus-related distributions. A second thing that was changed related to retirement accounts is that loans from qualified plans such as 401ks have been increased from $50,000 max to $100,000 maximum. So you can now take a loan from your retirement account of up to $100,000. And the last and important change to retirement accounts under the CARES Act is that required minimum distributions, commonly referred to as RMDs, do not have to be taken for year 2020. Required minimum distributions are calculated on the end of year fair market value from the previous year. And with the market being so high at the end of 2017 and the subsequent crash in 2020, Congress felt that it was only fair that individuals should not have to take out a distribution in 2020 based on a higher fair market value at the end of 2019. So those that have the ability to not take a distribution to live on should consider leaving those distributions in your account. We encourage you to reach out to your trusted advisor as you navigate some of these different rules. And please know that Henry & Peters is here as well to help you with anything you should need.